please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Fast Money starts right now, live from the NASDAQ market site overlooking New York City's Times Square. I'm Melissa Lee. Our traders on the desk are Pete Najarian, David Seaberg, Ryan Kelly, and Tim Seymour. Tonight on Fast, Wall Street's biggest bull calling for a near-term correction. What's got Morgan Stanley's Mike Wilson so worried? He'll be here to explain. Plus, check out shares of Amgen sinking after hours, adding to an already rough week. But a top technician says just keep buying this biotech stock. He'll make his case. And later, it's the showdown of the century. Noted Wall Street strategist Tom Lee and infamous short seller Andrew Left are here to battle it out on Bitcoin. One is telling clients to buy the Bitcoin investment trust, while the other says it's a bubble ready to unravel. It's a crypto clash you can't afford to miss. But first, we start off with what looks like the beginning of the bond bloodbath. Check out the 10-year yield hitting its highest level since March of this year, climbing toward 2.5%. Stocks took the move seriously. The Dow sinking about 200 points at the lows of the day before closing off those lows, still having its worst day in more than a month. So was today a glimpse, a little peek into what a rising rate environment looks like for stocks? And is this the biggest risk to the rally? Pete, what do you say? Well,
I would say that the velocity of this move is actually, I think, what part of the problem is. The digestion of watching this thing move as fast as it has. Now, do we get to 2.6? If we get there in the next couple of days, yeah, I think people are going to start to freak out a little bit. And obviously, you could see it today. The telephone stocks, AT&T, Verizon, those with the high yields, they were all affected as much as anything. Boeing had already had this monster day yesterday, but I still think it comes down to, Mel, as long as the velocity slows some, it still comes down to these earnings. The earnings have been powering this market. That's what's been pushing us to new highs. And if you go back to the earnings, you go back to the facts, the fundamentals of what's been going on in the marketplace. It's not just technology, it's industrials. And I think, but we got to see, if the speed of this move continues on the 10-year, then I think that's going to put at least a pause, if not
coincident with the session lows, we saw a turnaround also.
Yeah, I mean, yeah, we did. Look, you know, we have ECB tomorrow. We're going to get some feedback on that. I mean, it absolutely was, I think, earnings and ECB expectations that have shifted it a little bit. But earnings, you had Boeing very, I mean, look at the move that stock's had in the last 6 months. Look at the, you know, the sort of buy-in to that name. Of course, you're going to see a little profit taking. The earnings weren't that bad. That's the name I would defend here aggressively. Chipotle. I mean, think about the money that came off the table in Chipotle. That was a debacle. You have other higher, you know, stocks that had higher valuations because they were very crowded trades report. And they missed expectations a little bit.
But you know, I think the pain below the main indices was much worse than a couple of these names. Chipotle's numbers were terrible. Or at least their near-term outlook for growth in queso and is despite. And Guy called that yesterday, by the way. But this is a glimpse, Mel. This is a glimpse into central banks and normalization, what it might look like. I don't think rates are going to zoom higher. We're in a 5-year range. Having said that, I do think that things are going to move. I think this is extreme positioning. I mean, look at, and you've now heard 4 or 5, I think, people on the show, and let me be the 6th or the 7th. The RSIs, the relative strength indicators on the industrial average, are at levels we haven't seen in 65 years. You get to a place where you get complacent into this bull market. That is because the earnings, I think, have been great.
But you can be complacent when yields remain low, right, in terms of valuations. And when you see that glimpse into a higher yield world, you all of a sudden say, you know what, 18 times, that doesn't really fly.
It doesn't make sense. And we've talked about that, right? I do think the point is, so I want to be very clear about what I say, because I'm not calling for an imminent bear market. But the next bear market will begin because rates go too high. That's just how they always work. Now, I don't know if it's going to be today. I don't know if it's going to be 6 months or a year from now or 2 years from now. But you do need to watch rates. They are the single biggest threat to this entire bull market. Is it because they go too high or because they go too high too fast? In the short term, if they go too high too fast. But at some point, we reach that tipping point. And I don't know if it's 3% or 4%.
A steady, slower move in these rates
will be fine. But even if we have a steady, slow rate and somewhere around 3%, 4%. I don't know what it is. At some point, there is a reason to buy bonds at that level and not buy stocks.
There's also a reason why rates are going higher, though, folks. I mean, if rates are going higher, you have to believe in tax reform. You have to believe in the global recovery. We're right in the middle of the range of the Trump presidency, by the way. Forget the last 5 years. We're smack in the middle of the range on the 10-year. I realize we've had a nice bounce. But to say that they're off to the races has to assume a lot of great stuff.
Yields aren't going to go up to a point where they disrupt the equity markets, in my opinion, this year. If you are invested in the equity market, I'll ask you this question. Based on where the 10-year is today, knowing that there's the potential of tax reform right around the corner, knowing there's the potential of that upside in the tape, are you going to take money off the table and put it in the bond market at 2.48%?
You're asking me that? Because no.
No
and
way.
that's what I want to be very clear about.
Right.
No. But so I'm saying, I guess what I would say, let's flip it around instead of being the bear side. If we get a stock market sell-off because rates went up too fast in this period, then that's a buying opportunity.
But how are rates going to go up too fast?
Well, they have so far.
I don't know.
I mean, they have
demand for high-quality yield.
No,
rates gone up too fast.
No,
in the last several days, we've had a rally in rates, and the stock market has been lower. That's all. I mean, that's simple.
But you said, all right, I'm not trying to put words in your mouth. The rates have not gone up too fast here, folks.
I want to delve down into some of the sectors that felt a lot of the pain today, because on the surface, you saw 1% declines, et cetera. Not so bad. When you take a look underneath the surface, you see semiconductors down 1.5%, transports were down also about 1.5% or even more.
Look who's led us higher and higher.
Home builders were lower.
Right. I'm not as concerned about that. I think because if you do go by the facts and fundamental side of this entire story, AMD, that guidance was not strong. People, I think, looked at that. They said, hey, the earnings look great. Revenues are OK. Guidance, not so great. This is a stock that has moved very rapidly to the upside, so they're going to take some chips off the table. And no pun intended. Right. Well done. But it did pull But then later in the day, you saw some of the names start to turn back around. A Micron, for instance, that was starting to push to the downside, started to elevate back up. I think it did have an effect on all the semis. But I think the good semis, you want to be buying on those.
Such as, were you buying
like
today?
a Micron. I didn't buy today. I already own the calls and the stock, so I'm already double dipping.
Yeah, AMD absolutely turned the tape in the tech tape. I mean, it let it down. It let it lower because the forecast for margins weren't as strong as people expected. So, yeah, you're right. It had a massive move. People took chips off the table. It's, I think, a short-lived sort of phenomenon, but it's not necessarily signaling something that there's a problem within the overall tape or the investment thesis of those names.
It's not part of this rotation that we may start to see away from technology into industrials?
Look, we've, since the end of August, we've seen a rotation from defensive into cyclicals. It's been about 500 basis points of outperformance. I mean, this is going to continue. I think the pullback, and remember what got us even before to that period of August, it was mega cap tech. Mega cap tech, which offered you decent growth, if not very good growth, at valuations that were reasonable enough to hold your nose and buy, or not in some cases. So I think we've seen major rotation. I think if we continue to get a sense of tax, if we continue to get a sense of the global PMIs do what they're doing, and if prices are feeding through on the inflationary side, everything that's reflationary should still be bought.
All right. Well, Wall Street's biggest bull says today could be the start of an even bigger pullback. But that may not be a bad thing. Mike Wilson is Morgan Stanley's chief equity strategist. He has a 2,700 price target on the S&P 500. Mike, good to see you again.
Thanks, Melissa.
What kind of pullback are you talking about?
3 to 5%, probably max. If anything, we just need a pause. I think Tim mentioned RSIs. We did a study this past week. The RSI and the S&P has been above 70 for 15 consecutive days. That's only happened 13 times since 1975. Okay, so in every once in those instances, we see a pullback of at least 2%, an average of about 4 to 5%. So we're not calling for the end of the bull market. We still look at 2,700 by the first quarter. The rotation call, I think, is just as important, however, as what you own as opposed to how much you own. And that rotation call, by the way, is a continuation of the global reflation call from last year. And we've talked about this on this show many times. This year was about consolidating the initial excitement around global reflation last year. Took a pause. In August, it got totally priced out, and it was due for the second phase. And that's where we are, and that's what's happening right now.
Do you recommend people do anything in preparation for this 3 to 5% correction?
Depends on the client. No. Depends on the client, right? So in our wealth channel, most clients probably should just sit tight. If they've been following our advice and they've rotated into these late cycle sectors already, they're going to be fine. It may feel like Armageddon for a couple of weeks because we haven't had any corrections all year, but our advice is to sit tight. For shorter term people, it's probably the first tradable correction we've seen all year.
So, Mike, I'm curious, at what level in 10-year interest rates, because we were talking about that, do you come out and say, you know what, this is something more serious? Is it 3%, 4%? Where do we get?
Yeah, so this gets back to our original view on equity risk premiums. 275 is kind of a level we've assumed we can get to without seeing any degradation in our valuation call. 275 plus a 250 equity risk premium is 5.25 or 19 times. Today we traded 19 times calendar 17. So if we just roll forward into next year, we get to the 2,700, no problem. But above 275 towards 3%, I mean, it's going to become a valuation constraint. And I think you said earlier, it's right. Bonds become a real alternative at 3%, right? The real money starts to shift there. But we're nowhere near 3% right now.
So are there any catalysts you worry about the most in terms of triggering this 3 to 5% correction?
So there's a series of things that are kind of coming together. First of all, in August, we were begging people to step in, and of course, people didn't want to touch stocks at that time. And other people were arguing to buy stocks too, but very nervous about balance sheet reduction, very nervous about North Korea, very nervous about the Fed chair, who that was going to be. Now those concerns seem to be kind of put aside. I think the biggest concern, or not concern, but reason for a pullback is just earnings sell the news. That's the pattern we've seen all year. Stocks run into earnings, companies report the good reports, and then you just fade them. You know, that could be worth 3 to 5% right there. It's not the end of the cycle. It's not the end of the bull market. It's just third quarter earnings got priced. And now we have to wait for the fourth quarter and for 2018.
Have you put out a forecast for 2018?
We have not yet. We'll see about that probably later this year.
What's your sense right now?
My sense is 2018 is going to be a much tougher year than this year. I think this year, last 2 years have been fabulous. Low vol, great earnings cycle, but the 2-year comparisons start to come around in early 2018. So next year is going to be tougher. And once tax gets fully priced, what do I have to look forward to at that point? So it's going to be tougher. Next year is going to be a tougher year.
Mike, so there's probably a lot of money, though, that is sitting at home that says, I'm not in and I want to get in. Is this the wrong time? And again, I know you've said it's a pullback to buy. Yeah. And I know no one's going to ring a bell for these people when to get in and out. You're on the sidelines right now. Are you allocating?
Yeah, well, I mean, look, we're fully invested. We're overweight global equities at this point, so we're not doing anything right now. Our advisors who have cash in the sidelines at all time, I tell them, look, this is probably a time not to be incrementally bullish, right? That was back in August. Here's where you kind of pause a little bit. If you're doing dollar cost averaging, you know, if there are times when you accelerate that. This is not a time to accelerate. But no, we're not telling people to wait or pause in their regular allocations right now. We're in a secular bull market, right? We want people to be allocating towards equities probably for the next several years. And if we get pullbacks, we'll take advantage of those. But global equities is the place to be probably for the next 4 or 5 years in our view.
All right, Mike, thanks for stopping by.
Thank you very much.
Mike Wilson. Pete?
Well, you know, Mike brought up something really interesting, and it's something that I always trade off of, and not necessarily in the broader market, because the broader market is the broader market. I always am looking at individual names and very rarely even ETFs. But I'll give you an example. Home Depot comes out with incredible earnings. That stock eventually comes down about 10%. It's a buying opportunity. It's right back where it was. I mean, you can go across and see that time and time again, whether it's Apple in the 160s and then gets about $15 off of that, and then suddenly it's a buy again. I think within the market, you talk about rotations all the time, but within the market, when you've got great numbers and they come out with great numbers and they sell these off, that's the great opportunities in front of them.
Sounds like you're thinking of a particular stock.
What's that?
Sounds like you're thinking of a particular stock.
Well, there are multiple stocks, absolutely. I think, and if we see that happen in the text tomorrow, that would be exactly an area. If Microsoft, for instance, a stock I love, if they come out with the earnings I expect, and their Office and Azure and all that comes out strong, and they sell this off, that will be a buying opportunity.
Yeah, I mean, it's transitioning around earnings. That's the theme, and he nailed it. I mean, the patterns and the way institutionals are investing these days is very different than it was 3, 4, 5 years ago. There's a buy and hold strategy based on the fact that there's passive investing. The active funds are absolutely 1,000% out, turning their portfolios over as much. So you have less liquidity there. The buy and hold strategy remains intact, and it's simply we don't want to sell until there's a reason to around different, reasons. It could be earnings, it could be whatever, end of month and a quarter.
What'd you do today?
Well, here's what I didn't do, and you may hear me say this many times. I've said it before. I didn't cut my flowers and keep my weeds. So great quality earnings came through. A name like GM had a nice pullback today. You could say, oh man, was that the top yesterday? No, it wasn't. You're going to see upgrades. But there's speculative stocks. I own a lot of China tech, for example, that I think is going on momentum. If you see a break in momentum, and these are names that I have a tougher time sitting with difficult times, those are names I trimmed. I trimmed a couple names like that had already pulled back 5 to 10% in the last week. That doesn't matter to me. I'd rather get names that I'm less confident about off the balance sheet or trim at a time like this. And again, whatever that time is, I think earnings have proven to be very high quality.
Yeah,
yeah, for me, I actually set myself up for the earnings that are coming out tomorrow. So I talked last night about Google, how that might be an issue. You talk about some of the advertisers out there not doing as well. Maybe that hits Google. But talking about that rotation, what I want to be prepared for tomorrow is if we get a sell-off in Google, or I'm sorry, Alphabet nowadays, if we get a sell-off on that, I actually probably would stay. It'd always be Google to me. Yeah. But I actually want to probably be a buyer on that, assuming that there's not some kind of weird thing in their earnings. But if it's just a sell-off on some minor little miss here or there, I want to be a buyer tomorrow. So that's what I got prepared for.
All right, coming up, check out shares of Amgen sinking following earnings, but a top technician says there is something in the chart that suggests now might be the time to buy. Plus, General Electric shares continue to get pummeled. So are any of the top executives
What has been the experience so far? If I were to ask you about the 1-month report card of the GST rollout.
Well, the first week or so was a bit lukewarm. As time went by, I think we're now slowly starting to pick up and business is getting back to normal.
All the indicators are okay, nothing alarming. But it's an incredibly complex system.
We need to really see how will GST function when people start uploading their statements.
Distributors are demanding that GST should provide a higher margin for them.
Everybody is clear about passing on the benefits.
Vanja Sarna, the CNBC chief, very categorically she has clarified rate revision is something that the government is not looking at right now unless there is a justified case. That enforcement is definitely not there, but yes, government is keeping a close watch on any.
By about 1% in the quarter. Some really homing in on their new cholesterol drug. Sales of that drug growing a little more slowly than some expected, coming in around $83 million for the quarter versus expectations of more than $100 million. RBC calling that growth dismal. So looking for updates on that trajectory on the call. The company also gave an update on Puerto Rico. It does a lot of manufacturing there, saying it doesn't expect any product supply disruptions, but it did detail more than $100 million in impacts in the second half of this year from rebuilding there in Puerto Rico. No significant impacts in 2018. Finally, people will be listening on the call for any updates on M&A, business development around tax reform. Amgen ended the third quarter with more than $41 billion in cash. A lot of that overseas, guys. So we'll be listening for any updates there, Mel. Back over to you.
Thank you, Meg. Meg Terrell at headquarters. Well, our next guest says when it comes to Amgen, you should just stay calm, keep buying. Chartmaster Carter works of Cornerstone Macros over at the Plasma with more. Hi, Carter.
Hi there. So, yeah, I mean, obviously, this is the preeminent biotechnology company, and killing the market year to date, up 21 versus 14, but just in line with IBB. So no alpha as a pick relative to biotech. But I think what's important is this. As unhappy as this is, the next chart's going to put this drop in perspective. So we see it's trading here at 173 post-close. Now, take a look at the chart of Amgen. This is a 5-year chart, how it broke out. This bottom trend line right here is exactly where the stock is indicated, meaning it's probably already found the level that it's going to find. But the key is that it flirted with breaking out once. Often you get a little pullback, which we're getting. That's no big deal, I would say. And then the real bet is that ultimately the way forward is out of this formation. So, again, hasn't done anything relative to biotech, but a beat the market kind of stock and best in class in terms of biotech generally. Let's talk about IBB, and then I'm going to quit. Here we go. So we know that biotech's been weak. 1 week performance, this column, 1 month performance. Biotech by far worse than healthcare, and healthcare worse than the market. Obviously, over the last month, same pattern, right? So biotech as a subset of healthcare, healthcare worse than the market. Okay, so let's do a few lines and take a look. A 2-year chart. Often, people call these double tops. You get back to a prior high and you find difficulty. But the key is we have a well-defined uptrend, a sequence of higher lows. How do we get there? For starters, take away that line and take a look at this first chart. What we have, it starts with a triple bottom. And then add another line. It starts with this formation. And then add the final line right to here. Now, all we're really doing in principle is checking back to that trend line, which in principle should then get us back on our way, a perfectly normal sequence of higher lows, higher highs, and I think ultimately we take out the high, which is what this setup looks like. So I want to buy the weakness in Amgen because of the news.
I'm not even going to ask. It is taken for granted here that Carter comes over.
He comes over. No question. The question is, does he want to come over? Does he want to come over?
Oh, I didn't even think that you would say no.
Yeah, he could reject it.
He could say no. Biotech is part of the NASDAQ. It's part of technology, basically. So, and it's part of healthcare. What kind of correlation is there? Is it a tighter correlation to technology? Should we be worried about a tech chart when it comes to biotech, or do we say healthcare is strong?
That's right. Well, individual equities, some are higher beta, right? It's really about the beta. But as a group, in principle, let's call it QQQ type names, there's a lot of correlation, or at least people treat them the same, whether they deserve to be correlated or not. The issue, of course, what we know is so much hinges on a few big names here. One of the things about a market in general is if you have a lot of potential, in principle, there's potential higher. But if you have exploitation of potential, meaning every Caterpillar that breaks out, every 3M that breaks out, you've exploited some of the potential that could go higher, meaning you've used fuel. So from this point forward, you will need the big fellas coming up this week to produce results to push the market higher, definitionally.
Carter, from a technical perspective, did you see any change in character when Gilead does the deal with Kite? We got to a place where a lot of these charts, and not to get overly technical and wonky, but you had flag formations, they gapped up, right? And they started to consolidate. That usually is bullish. It hasn't been this time.
Right. I mean, sort of almost maybe euphoric, right?
Yeah.
Thinking, and we've seen that to some extent in semis, where there's the M&A comes along. You can start to put any dreamed multiple you want on it because it's all unknown, right? The Kite thing was a big thing. What we do know, though, is if you were to have to make a structural bet on a longer-term basis, there's a lot of opportunity in biotech, whereas other parts of the market don't have that.
You know, we talk about volumes all the time, so I'm curious, in the biotech world right now, whether it's Amgen or Gilead or Celgene, any of these names, are the volumes there that encourage you with what you're looking at on the charts themselves?
Well, what's interesting is most of the volume's been very heavy dropping and gapping. We've seen that in Celgene, we've seen it in BIIB. It's going to happen tomorrow in Amgen. Right. Meaning that's typically signs of either news-related selling or just general get me out a little bit, let me reduce its distribution. But it hasn't damaged that IBB pattern, and I think that's the primary point that I would say.
Carter, thank you.
Thank you.
Carter Braxton Worth. Would you be a buyer of Amgen?
I love that call. I do. I think large cap's in favor. I'd want to stick with the large cap names. You look at the Kite, the deal that was structured there, the Gilead Kite deal, that was sort of the signal, the all clear. You can step into large cap biotech again. The IBBs is the way to express sort of a position there. And I say, I love the Amgen call. I think Amgen is a name you want to own here on the week.
But I think what I like most about the Amgen call, quite frankly, I'm not in any of these biotechs right now at all. First time in a very long time. Well, I'm in Merck, I'm in Pfizer. Amgen's the most interesting one to me. I like what Carter had to say about the chart. I love the $41 billion they've got. And the fact that they sort of cut back on declining sales and they cut back on some of their cost controls makes me wonder, are they in a position now where they're going to pull a Gilead? Are they going to finally pull the trigger with $41 billion at hand to make something actually happen in the future? I think they are.
All right, still ahead, big tech on deck, trillions of dollars at stake as Google, Amazon, and Microsoft and Intel all get ready to report earnings after the bell tomorrow. We'll tell you which names traders see having the biggest move. I'm Melissa Lee. You're watching Fast Money on CNBC, first in business worldwide. In the meantime, here's what else is coming up on Fast.
It's a General Electric blender. And it's shredding shareholders.
Closing bell earlier today about the shift in the retail space and the company's transformation plans.
I think we've seen that acceleration of the retail consolidation going on over the last 12, 18, 24 months. And that's obviously de-accelerated the overall market. So what we're doing is actually shifting our position to go more direct, to create more differentiated retail, and to create a better experience for the consumer moving forward.
One-day wonder, or is it turning the corner?
Well, look, I mean, there's a high short interest name, and they come out and they give their 5-year plan, and everybody's going gaga over it. The reality is, we talked about this when Skechers reported. We said you can't be short these names because of a risk like that. It came out, I mean, obviously there's a lot of short covering today. The structural decline in their business is not something you can back off and forget about. Adidas is coming in and taking market share. Their products aren't necessarily identifying with, or you could say children or consumers aren't identifying with their product. The reality is this is a name I would absolutely not be buying here. I'd be taking profits here if I own the stock or taking chips off the table.
If there's a structural decline in their business, there's a structural decline in Adidas' business.
Not true. It's a different product band.
Absolutely not.
Totally different.
I mean, look, so the bottom line is Adidas has been a great call, and Nike is underperformed. But this Investor Day reaffirms that DTC, if anybody's in control of their history,
projections out there.
It's Nike.
Hold on. Let's him talk first.
Yeah, so look, bottom line is, Adidas suddenly has the cool factor. By the way, growing up, anybody I knew anyone that was cool was not wearing Adidas. Vans, it's all in the price. To tell me that the stock is structurally dead, you have to tell me that athleisure is dead and that people aren't buying sneakers because they are the brand.
All right, still ahead. Check out Buffalo Wild Wings surging nearly 20% after hours. We'll tell you what's driving the stock, plus GE sinking to a fresh 52-week low today. But company insiders are doing
the distribution of Bitcoin Cash. And it also says that in the filing. So this is bad and worse all rolled up into one.
Since left shorted the GBTC, it has fallen 33%, while the price of Bitcoin has soared. Now, Tom Lee, on the other hand, has taken a more constructive view on the cryptocurrency. In September, when I asked Tom if he'd buy Bitcoin over U.S. stocks, this is what he had to say.
I unequivocally believe Bitcoin is your best investment into the end of the year.
Pretty straightforward. Since then, the S&P has rallied 2%, while Bitcoin, by comparison, has outperformed the market and surged over 46% in that time frame. Well, Tom Lee came out with a note today on Grayscale's Bitcoin Investment Trust, the very same thing left is short, saying that it is, quote, an attractive way to gain exposure to Bitcoin and one of the only games in town. So two of the street's biggest voices on Bitcoin at odds with one another. We thought we'd invite them both on for the ultimate Bitcoin battle royale. Tom Lee joining us from Stanford. Andrew Left is coming to us from Los Angeles. So Tom, let's start off with you. Why are you so bullish this particular vehicle, the Grayscale Bitcoin Investment Trust?
Well, there's a couple reasons. I mean, I think primarily the Bitcoin Investment Trust gives you exposure and most of the upside of owning Bitcoin, but in a liquid vehicle. So as we published in our report, if Bitcoin reaches our $25,000 in 5 years, the GBTC is going to be valued at around $2,500. So it captures roughly 80% of the move. And that's assuming the NAV goes from 20% today to 0, the NAV premium.
Andrew, why is Tom Lee wrong?
Well, first of all, he said if you believe in Bitcoin, the GBTC will allow you to capture most. Why capture most and why not capture all and just buy Bitcoin? That's liquid as well. As a matter of fact, the Bitcoin Investment Trust really is not that liquid. So that's on this particular vehicle. Not to mention the fact that they don't have insurance on the Bitcoins they are custodians of. They are giving a distribution of Bitcoin Cash. But if you wanted to buy Bitcoin, just buy the Bitcoin. Most importantly, what really bothered me, and the reason why I'm here today about Mr. Lee's call, and he should know I'm a fan of Mr. Lee. When he's on CNBC, I make sure I listen in, I turn up the volume. And I know that when you discuss about GDP growth, maybe it's not that sexy, and saying Bitcoin 25,000 is sexy, but I think it's irresponsible right here. A year ago this week, this was around $690. We don't even know what Bitcoin is right now. He referred to it. His target is basically around 5% of the price of gold, looking at it as a commodity. I know other people are looking at it as, I know Professor Damodaran is actually referring to it, looking at more of a currency. And now we see Bitcoin itself in the past 6 months, this year, has gone Bitcoin, Bitcoin Gold, Bitcoin Cash, and then now we give another spin-off of Bitcoin in 2 weeks, Bitcoin 2. So all these different variations of Bitcoin, it has to find its identity. But before you go out and tell people 25,000 and allow people to think, hey, I'm going to get rich, I'm going to jump in right now and give them a chance to do it. And the thing about the GBTC, it's an easier way for someone to buy it than actually opening a coin wallet. I just think it's not responsible, Mr. Lee. You have to acknowledge the fact of where this was a year ago, and people are watching you, average investors, and before they start buying Bitcoin at $5,600, they should think twice, more than twice.
So, Tom, and by the way, when you say Mr. Lee, I keep thinking you're talking about my dad. Tom Lee and I are not related, not related in any way. But Tom, you know, Andrew makes a good point. Why not just buy Bitcoin itself when you see that this particular vehicle doesn't necessarily track the rise in Bitcoin? Maybe Bitcoin rises to your target price, but the Grayscale Bitcoin Investment Trust may not.
Well, Melissa, I agree. In fact, I might even say I didn't even disagree with a single thing Andrew said. I agree. This is a very risky investment. But the advantage of owning GBTC is one, for our institutional investors, unless their mandate allows them to take custody of the coin, they're going to have difficulty actually buying the underlying coin for their clients, but they can actually buy this ETN. Additionally, for clients who have 401ks, et cetera, this is a way to get some exposure. But as we've written clearly in our white paper, we think an exposure to Bitcoin is a small percentage of your portfolio. It's just that it's an uncorrelated asset. And because it has negative correlation to other assets, just a 2% exposure actually helps your overall returns without letting you take that much risk. So I agree. I think when we talk about 25,000, we don't recommend anyone put 100% of their holdings in this instrument. But again, it's very easy to buy this because it's publicly listed.
Andrew, Mr. Lee makes a lot of good points there in terms of some institutional investors' ability to actually take possession, take custodian of the Bitcoin. In terms of your view on Bitcoin, though, Andrew, is it specific to this vehicle that you're short this vehicle? Or is it also that you would also, if you were able to, that you would short Bitcoin itself?
The difficult thing, if you believe Bitcoin is so I was short the vehicle initially when it was 100% of the net asset value it was trading, and it turned out to be a tremendous trade. Now, right now I'm still short in smaller size because I have to respect what could be a bubble. Now, and I'm not saying the underlying technology behind Bitcoin, but when you have BlackRock, who came out today, Goldman Sachs, and not even that, most importantly, the SEC today, after the close, pulled the registration of the Grayscale S1 for the Bitcoin ETF. So when the SEC and the Goldman Sachs or BlackRock are saying this is uninvestable, yeah, I'll be short some at these prices, but I'll be short cautiously. But most importantly, when a headline comes out that Mr. Lee puts out and was picked up widespread with a $25,000 target, based on 5% of the total gold outstanding, I found that analysis maybe at 1,000 or 800, but I think he has to understand what he could have done to the individual investor who's going to follow him into this trade at 5,600, and it's irresponsible, even if they happen to miss it and it goes to 7,000 without them. It's simple as that.
Tom, what would you say to Andrew or to the individual investor who you apparently steered wrong?
Well, I might completely agree. We don't know how to properly establish what the upside ends up being for blockchain and Bitcoin. We've spent a lot of time on this, and I used to be a tech analyst. It reminds me a lot of how it was very difficult to understand how the web was going to affect the economy or even social media. But one of the challenges is that as an investor, you do want to have some exposure. I mean, imagine if you could have bought Google as an early stage company in 2000, but you were worried because you didn't know if, how big the search market was going to be. I think that's really the same issue you'd face today when you think about blockchain. And again, I wouldn't want investors to put 100% of their money into Bitcoin, but I would say that when you look at bubbles generally peak when an underlying asset class is 35% of the addressable market. That's the Nikkei in the 90s. That was gold at its peak. That was the housing as a percentage of GDP. That was the NASDAQ bubble. That was the biotech bubble. So to treat Bitcoin as a bubble today, you'd have to say it's 35% of a market. So that means Bitcoin's 35% of a $300 billion market, but what markets are $300 billion today? So I actually think it's still early, and it's not late stage to be looking at Bitcoin as an investment.
One last word to Andrew left. Andrew, I don't know if you agree with the likes of a Jamie Dimon who thinks Bitcoin is a fraud. How does this end in your view?
I think the word fraud is a big word.
Okay. Does it go to zero? Is this a bubble waiting to burst?
It's not, by the way, I don't think it's like Google in 2000. I don't know if Google was public in 2000. I remember Yahoo in 99, though, when it was like 130 or more of those. This could be the first stage of what we see of blockchain. As for Bitcoin, I mean, what do we buy, Mr. Lee, in 3 weeks? What do we buy, Bitcoin 1 or Bitcoin 2? Do we buy today, we see Bitcoin Gold, Bitcoin Cash. I think if this is going to become investable long-term for the future, it needs to stop being so volatile. It needs to keep its identity, and it has to be labeled, and we understand, is it a currency or an asset?
Okay. Gentlemen, thank you for your time.
Until then, it's uninvestable.
Good points on both sides. Andrew Left and Tom Lee. BK, resident Bitcoin expert, what do you say?
Well, listen, I think I'm more with Tom Lee on this, right? Obviously, I'm biased, but if you look at Bitcoin, one of two things. I think Tom's actually been quite measured in what he said about this. He's got a 5-year target that says, hey, if Bitcoin gets to be 5% of the market cap of gold, here's your price. He's also said, put 1 to 2% of your investable assets in that. And I think that's about the right number because we are very early stage. And we got to know that tech disrupts tech. Andrew mentioned that Yahoo was, the big name in 1999. We didn't know that Google was going to come along. I don't know if Bitcoin is going to be the ultimate winner, but I do know that there will be a token that trades around the world that represents blockchain, that is a global currency. Right now, it looks like it's Bitcoin. It could be something else. Why not have some exposure to it?
Coming up, nearly $2 trillion in market cap at stake tomorrow as tech titans Amazon, Microsoft, Alphabet all report earnings. We'll tell you which names traders see moving the most. More Fast Money still ahead. To break it all down for us. Hi, Mike.
Hi there. So, sure, we're looking at some pretty big moves, certainly in market cap terms. Amazon's looking at about a 4% move according to the options market. Alphabet, aka Google, also about 4%, and Microsoft about 3.5%. Put it all together, that represents about $67 billion in market cap swings, potentially, as far as the options market is concerned. And a quick point about that also, these are in line approximately with the average moves on earnings over the past 8 quarters for each of these.
Pete, just earlier you were saying if Microsoft saw a pullback on the back results, you would consider buying. Is that sort of a pullback, which is an average move?
Yeah, 3.5%. Sure, I'd probably add because I'm already in it. I'm in the calls and the stock once again in that name as well. I believe in the story. I see their growth. I think they are taking market share away a little bit, at least from AWS and the rest of the competition. I think their growth is strong enough that I would definitely want to be buying.
Yeah, I think the best setup going into earnings for these two names, or for an Amazon, let's say, and a Google, is a Google. It's all about the acquisition costs. How it comes in, are they decelerating or accelerating? If they're decelerating, the stock's going to rip. I think you're going to see potentially a gross margin. Gross margins are the most, or op margins are the most important thing with Amazon. If there's a little bit of an uptick there, that stock could rip as well.
I mean, what an impact this could have on technology, right?
Yeah, look, it's a big day, and I think the expectations are not terribly high. I mean, in the case of Microsoft, I think the expectations, I think the comps are getting difficult, but I think what they're doing on the commercial cloud and Azure are soaring. The gross margins are expected to be better. With Google, I mean, all the Google sites, hardware, and then in terms of their advertising, YouTube is really starting to move the needle. I think YouTube is very undervalued in their entire complex, so yes, stay long into those numbers.
Yeah, actually, I think that is the wild card here, right? So earlier I talked about, advertising is slowing down, or it appears with the big ad companies. Maybe that's going to come over to Google, but they do have a lot of ways to monetize. So I think on any type of a sell-off, or on any type of normal sell-off, I think Google or Alphabet is the place to be.
All right, Mike Coe, thank you for that. For more options action, check out the full show Friday, 5:30 p.m. Eastern Time. Coming up, another tough day for GE as the stock hit a new 52-week low, but company insiders may have just done something that could be
going into this activism, and I'm not sure that you have to jump into this, but again, advisory firms coming on board is not a reason for me to say that Ackman's in the driver's seat.
All right, let's switch gears here. And stop me if you've heard this before. But General Electric shares were lower today, down another 2%. The stock is now down 15% in the last month alone. But there could be a light at the end of the tunnel, and it's coming from the C-suite. Morgan Brennan's back at headquarters with the details. Hi, Morgan.
Hey, Melissa. Tough month, tough week, tough year. Now down nearly 32% for 2017. But with a new CEO and management team in place, insider activity is offering some clues about how execs and directors are viewing GE's prospects. Now, we combed through SEC filings with help from Insider Score and Equilar. It's telling. Insiders rarely sell at GE. That hasn't really changed. Ben Silverman at Insider Score says since 2007, only 8 insiders have sold versus 20 who have purchased. This year, 2 sales, aviation chief David Joyce in February and more recently in August, selling by outgoing vice chair Beth Comstock. Before that, 2016, had only 1, a transaction by outgoing CFO Jeff Bornstein, his first and only sale on record. That one and Joyce's this year were for real estate transactions. Comstock, not really clear. But the buying is what tells the bigger story. Former CEO Jeff Immelt was a pretty regular buyer over the years, including 4 weeks before his retirement was announced. New CEO John Flannery seems to be taking a similar approach. In August, he boosted his stake by 20%, spending $2.7 million on 104,000 shares. Now, GE has a stock ownership requirement. A CE has 5 years to build an equity stake that is worth 10 times starting salary. But I'm told Flannery's already met that. Here's where it gets more interesting. He isn't alone. Since April 6th, other board members bought, including James Tisch of Lowe's, whose $2.5 million investment, according to Insider Score, was his first since joining the board in 2010. So perhaps a vote of confidence. And it would seem, looking at what the stock has been doing, right when GE may need it the most. Melissa?
Morgan, thank you. Morgan Brennan. And while insider buying isn't always a buy signal, it's not the first time the CEO has jumped into a falling stock. In fact, check out these 2 winning bets. JP Morgan, remember CEO Jamie Dimon stepping in to buy about 500,000 shares, around $53 a share in February 2016, in what turned out to be the diamond bottom. The stock has nearly doubled since then, up 90%. And Wynn CEO Steve Wynn doubled down back in December of 2015, scooping up about 1 million shares, around $64. The stock is up more than 120% since then. So given all of that, Do you think the rise in insider buying in General Electric could be signaling a bottom in the stock? Pete, I go to you. You cite Steve Wynn and that purchase
and
specifically.
I still own Wynn because of what Steve Wynn did, and I really put it out there. I mean, the guy was unbelievable. We documented that every time he'd go and buy just to say, hey, look, here's the one difference, though. Steve Wynn was buying stock in a stock that he knew very, very well. Not that these guys don't know there, but it also had the fundamental backdrop. I still don't understand the fundamental backdrop of GE to say, you know what, this is the bottom and I need to buy because the insiders are showing me some leadership. I like that they're doing that. I think it is a commitment, Melissa. But when I look at the fundamentals of the company, I'm not blown away to say, you know what, they've still got to make some changes before this thing can turn.
The implication or the thesis behind believing in insider buying, though, is that the CEO, theoretically, or the C-suite knows better, knows about the industry, and is eating his own cooking, so
although
to
the
speak.
previous history of GE as she went through that doesn't show me that, didn't impress me all that much in terms of GE.
I mean, it's just they don't have the track record, right? I mean, it's just like any portfolio manager. Jamie Dimon has the track record. Steve Wynn has a track record. There's no track record here. The track record is they buy it and it keeps going lower. So I don't think there is a read-through on this.
Yeah, I mean, it could be close to a bottom, but it could also be dead money for a very long period of time. The risk of a dividend cut, the aspect that they have to sell a ton of assets, turn this ship around is going to take a long time. I'm with Pete.
Tons of bad news in this stock. I bought it a week ago. I'm comfortable owning it.
All right, up next, final trade.
What has been the experience so far? If I were to ask you about the 1-month report card of the GST rollout.
Well, the first week or so was a bit lukewarm. As time went by, I think we're now slowly starting to pick up and business is getting back to normal.
All the indicators are okay, nothing alarming. But it's an incredibly complex system.
We need to really see how will GSTN function when people start uploading their statements.
Distributors are demanding that GST should provide a higher margin for them.
Everybody is clear about passing on the benefits.
Vanja Sarna, the CNBC chief, very categorically she has clarified rate revision is something that the government is not looking at right now unless there is a justified case. That enforcement is definitely not there, but yes, government is keeping a close watch on any such issue which will trouble consumers.
Exclusively on CNBC TV18, follow the leader.
From identifying the movers and shakers of the week to spotting new trends as they develop, we get you all the buzz in the commodity market and help you connect commodity to the company. Let the biggest champions guide your investments and find out on what to expect in the week ahead.
The Commodity Champions. At these times, only on CNBC TV18.
Commodity Champions, brought to you by Nakshatra Diamond Jewelry.
Class. Speed. Raw power. Max torque. Get ready for an unmatched automotive experience. Servo presents Overdrive.
Overdrive, presented by Servo, world-class lubricants from Indian Oil.
What's hot and what's not? Buy in or sell out?
We keep track of all the market movements, so you cut to the chase and make the right call.
Post your queries on moneycontrol.com or SMS 51818.
Our experts will help you customize your stock portfolio and plan your investment strategies.
Your stocks at these times. Only on CNBC TV18.
Brought to you by magicbricks.com and Renault Capture.
The clock is ticking, and we have reached the most crucial hour of the trading session.
Hello and welcome to Closing Bell. I'm Sonia Shenoy.
Everything could change in an instant.
You could argue that it's buy on dips, you could argue that it's sell on rally. A smart trader would say it's both.
Tune in to find out what could make or break your trades.
It's been a very good comeback for the markets.
This is a market which should rally more, maybe go to all-time highs.
As our experts analyze the market from every angle to give you the inside story.
Arvind remains a short sell even in this market.
Several individual stocks are breaking out. So Bata is a buy and Aurobindo Pharma is a buy.
Keep taking each day as an independent day and trade accordingly.
NSE Closing Bell at these times on CNBC TV18.
Closing Bell, brought to you by Fine Cure Pharmaceuticals, Nanolia, and Biba.
This is TV18, and you're watching